Welcome to the Share the Wealth Show, where minority professionals can learn to escape the racial wealth gap and catapult themselves into abundance. Your host, Nicole Pendergrass, grew her net worth from being negative to multiple six figures. Join her on her investigative mission to expose secret strategies of the wealthy so we can all have the tools needed to build the life and legacy we were created to possess. Now it's time for the show.
Yeah, that's a really good question. And short answer is a bunch of them, right? But the one of the driving factors, especially when we talk about the tax planning side and the efficiency side, the primary vehicle is going to be the business and how you use it, right? So when you look at the tax code, how it's written, where the advantages are, it really comes down to two sides of the coin. Investors benefit and business owners benefit. And when you're both, then it's kind of like a double benefit there. But having a business is going to drive a lot of opportunity when it comes to tax savings and effectively using that business to, one, grow it, right? Because that's how you're going to build wealth, but also using it for opportunities for tax deductions. And that's strategically spending money in places that advance the business, but also reduce your taxable income. That's where you start to win quite a bit. From a tax perspective, when we look at a C corporation, the reason it's not usually built for most businesses is because of that double taxation feature. Well, what does that mean? That means as the business earns money, if it's taxed as a C corporation, it earns money, it has expenses, there's a net profit at the end. That net profit, as it stands right now, is taxed at 21%. It's a flat tax. Doesn't matter if you make $1 or 21 million, it's 21% on that number. Well, as a shareholder, when I want to pull money out of that corporation, I either have to take it as a wage, which basically means I'm paying Social Security and Medicare tax, or I have to take it as a dividend, which basically means I'm going to pay 15 or 20%, depending on what my bracket is. If I take it as a dividend, dividends are not a deduction. So my company paid 21% tax on that number. Then when I took it out, I pay 15% tax. We're at 36% pretty quickly. That's usually not favorable and advantageous to folks who are growing a business. Now, C Corps are valuable if you're planning to go public, if you're trying to achieve certain asset protection, or if you're spending down enough money to where the corporation is not extraordinarily profitable. So for some of us, we're in a 30, 35, 37% bracket. That 21% looks kind of attractive. So we can have the corporation to facilitate some of those earnings, but we want to spend down enough to where it's not a huge amount that we're paying 21% tax on. And if and when we take it out, it's at some future date and for a very specific reason, or we can facilitate asset purchases through that corporation so that we don't have to take the money out. That's where the C Corp becomes advantageous a little bit. Now, the S Corp, that tends to be most of our best friends because as we're growing a service-based or product business, the S Corp allows us to get rid of employment tax to an extent. Employment tax is another way to say Social Security or Medicare tax. That's why people love the S Corporation. Well, in the event of real estate, that's passive income. It's not subject to employment tax anyway. So it doesn't necessarily need to be inside of an S Corp in order for you to be tax efficient. The second thing is whenever an asset is inside of a corporation and you want to pull it out and move it, that's considered a distribution at fair market value. That's taxable to you. So when you think about deeding properties in and out of LLCs, if you deed a property out of an S corporation, technically that's a distribution and that's taxable. If you move a property from your S Corp to your trust, technically that's a distribution and that's taxable. Amongst a number of other things, there are problems with the excessive losses and basis and a bunch of nerdy stuff that we can get into that just doesn't make corporations that tax efficient when we're talking real estate specifically. We have what are called lifetime exemptions. That basically means throughout your lifetime, you can give away up to this amount of money before you have to pay an estate tax, okay? So right now, that number is extraordinarily high. It's 12 million. For a lot of us, we won't see $12 million worth of assets in our lifetime, but for some of us, we'll actually reach it. And married, filing joint, now you're up to $25 million because those two come together. Okay. That's actually due to sunset over the next couple of years. That number is going to easily slide back from 12 down to 5 or 6 million, somewhere in that range. That's a huge difference. For a lot of us, we will actually see $5 to $6 million worth of assets in our lifetime. If you think about the value of our business, the value of our retirement accounts, the value of our life insurance, the value of our real estate, that could easily reach that number pretty quickly.
Yeah.
So when you go past that number, the difference between that number and whatever is above it can be taxed to the tune of 40%. And if you live in a state that has a state tax, that number goes even higher. So that's why it's important to do some of this planning ahead of time, and shifting things in and out of your estate while you're still alive. But in the example of this property, if you passed away and you're below that exemption, there's no estate tax, there's no death tax, there's no tax that's paid on that property when it transitions to the next generation. Now, if you're above that number, totally different. We got to do some more planning. But if you're below it, which a lot of folks are going to be, you just inherited a $700,000 property with no tax implications to go and do a lot of cool stuff with. So the four basic parts of an estate plan that everyone should consider and or have: one, power of attorney; two, medical directive; three, make sure you have a will; and the last one is a trust. And the trust, that actually deserves its own episode on its own. A lot of confusion about trusts and how they work, but the initial goal, and again, this is before we get to very advanced planning, is so that your assets can bypass the court system. They bypass what's called probate. There's no challenges. It can go to the next generation and everything runs smooth. And then you can put provisions inside that trust to say, hey, this property, this money, this whatever is in this trust is not intended for my kids. It's intended for my grandkids. Or my kids can't touch this money until they do X, Y, and Z. Graduate from Harvard and Yale with a 3.9 GPA or something like that. So you can do all those kind of stipulations, but the trust is not the primary vehicle, at least not yet, until we get to the advanced side to bypass that estate tax. It's really to give you the protection to pass your assets without getting tied up in probate or court. Now, once that's set, step two is, well, how do you structure your trust and your estate in a way that's very tax efficient? Mm-hmm. By default, what most people do is they fall back and they say, hey, I know I'm going to be over the limit. Based on my projections, my estate will be worth X, Y, and Z. That number times 40%. I need to get a life insurance policy that can cover that number. That's great, but I think you can do more, right? Okay. And so one of the things that you can do while you're still here, especially with these exemptions and these limits being so high, is that you can start to give things from yourself to whoever it is, your next generation, whether that's kids, grandkids, or what have you. You can gift that stuff to them now, and that can now be moved out of your estate. So you use that exemption while you're here instead of losing it in the event that you pass away. The second thing, I'm going to pause there. You look like you got a question.
I do, but keep going.
The second thing to consider, especially with respect to life insurance, and if we're talking larger values, larger policies, and things like that, is using what's called an ILIT, an irrevocable life insurance trust. Now, absent an ILIT, the value of your life insurance, while it's not taxable, meaning if you pass away, the death benefit is not taxable income to your beneficiaries, it is included as a part of your taxable estate. So it's included in that number to determine whether or not you're over that $12 million limit, right? But that we just talked about, which is soon to be 5 or 6. So if you've got, $5 million worth of property and a $2 million life insurance policy, you got a $7 million estate. You're over the limit. If you use an irrevocable life insurance trust, that $2 million is now no longer a part of your taxable estate. Your estate is now $5 million. And, if you're below the limit, that's great. If you're a little bit above, you can still use those proceeds to pay whatever the tax is. But now that tax is going to be $2 million short because the life insurance policy is no longer a part of that estate. Now, those are just kind of some of the basic steps. We can continue to go further into some other things, but those are some things to kind of get people thinking of what moves can you make now. The thing I also say about this too, I love talking estate strategy and planning. A lot of us tend to believe that this is only for the wealthy, the super wealthy, the ultra rich, and things like that. these are going to be real world problems that are going to hit a lot of, especially middle income Americans, as they continue to build and accumulate wealth. Because as we just demonstrated, if that exemption slides back to 5 or 6 million, and you accumulate enough wealth to to go past that, which is very possible, just based on properties, insurance, and businesses and things like that, you could face an estate tax problem.
Looking to build wealth with real estate? Are you all tapped out on YouTube University and ready to get help tailored to your specific situation and goals? Have you always known that you were a little different from the crowd, that you never liked following the status quo, and that you're just tired of living in mediocrity? You want to build wealth on your own terms outside of Wall Street? Well, then maybe the Microfamily Mavericks mentorship program can help with that. It's a community where I handhold you through the process of buying your first small commercial multifamily building, because not everyone is ready for 100 units out the gate. Why multifamily? Because it gives your rental income a hedge against vacancy. Imagine what happens when your single family rental tenant leaves, right? And why commercial 5+ units? Because you have much more control over increasing the building's value in the commercial space, and then in turn, increasing your own net worth. Starting small is a stepping stone to so much more, because then you can tap that equity and buy another building and another and another, and you get the point. So increasing your cash flow and your ability to be job optional along the way. It's all a part of the journey. So if you think big, but you want to start small, and if you know multifamily real estate is a way for you to open the door to building a life of freedom, abundance, and legacy, but you just need someone to guide you step by step, and you want to be surrounded by other people on the same journey, doing the same thing, then just click the link in the show notes to find out a little bit more about the Microfamily Mavericks, and I look forward to potentially seeing you on the inside. So now back to the show.
When you're an employee, everyone knows you get your FICA taxes taken out, and typically your employer pays half and you're paid the other half. Mm-hmm. The other aspect that people don't realize is that when you go self-employed, you're now responsible for all the FICA taxes. That's additional 15.3% on top of what the government, the federal income tax rate, as well. So that's why it goes from employee being taxed on 30 to 40% of their income to self-employed individuals being taxed on 50 to 60% of their income. And yes, people think like, hey, I can get all these write-offs, and all that, but unless you're actually growing a business, like they're like basically taking their jobs and making it into a business, and you're still an employer or employee of your own business. But unless you're expanding and doing certain, like elections to be taxed favorably, you're always going to be hit with that additional tax on your full net income. So that's one end of the spectrum, when people just like kind of making a lot of money and like not really strategizing their entity or their corporations of ways so they can be more tax efficient from there. The other spectrum of it is that people write off too much and they're writing off everything because they don't want to pay any taxes and they don't want to show any income. And then you're trying to get a loan. It's like, okay, you're not showing the income from your business. So there's a delicate balance like between the two, and that's what people have to learn about if you're doing an active business. Like when is the right time to be an S Corp, when is the right time to be a C Corp, how to pay yourself a reasonable salary, because just being an LLC isn't enough from that. And then how to like run expenses through the business properly so that you have the proper documentation. Because like I say, I tell people like I'm very aggressive when it comes to finding all the write-offs, but I have to have supporting documentation so that everybody can sleep well at night. I just can't put a $10,000 expense if there's no $10,000 invoice to support it. When you're talking about just being an LLC, or even just a sole proprietor, say you don't even have an LLC, because the purpose of the LLC is really to create some asset protection. Like it's not a tax saving mechanism, because I can just be Larry Pendleton CPA and run my business that way with no LLC. If I write off this marker, like it's still a business expense. Like it doesn't matter if it's under an LLC or not. It's just I'm running a business that can prove that is from that standpoint. Then you still want separate bank statements of business and personal bank statement, track all that. So once you can understand that the LLC is not going to create all these tax savings, you didn't understand that if you are just a single member LLC, which is a disregarded entity, all that's going to be reported on your Schedule C, pretty similar to if you're just a sole proprietor. So that's where that 15.3% hits the bottom line, like no questions asked, from there. And even if you're a partnership, you may file a separate business tax return and you get a K-1, that's still considered a disregard entity because all of the income and all the tax is going to be hit on your portion of the partnership as well. Now, once you're actually, and there's a timing aspect as well, where like once you're growing and you're netting a certain amount of income, then it's time to kind of consult with your tax advisor of when to be a S Corp election. Because the S Corp election, once again, doesn't provide any legal protection outside of just LLC. The purpose of it is so that you can now separate yourself from your business so that you are the employee of your business. Because as an LLC, you and it is the same thing. Even if you have a separate EIN number, like it's all going to be considered one thing. But if you're now separating yourself from your business, and that's what the S Corp election does, now you're paying yourself a reasonable salary because at LLC, you can't pay yourself a salary. You can pay somebody else's salary, but you can't pay yourself. Now you pay yourself a separate salary. Your FICA taxes are all going to hit your salary. So if you're netting $100,000, your minimum tax bill, if you're just an LLC, is going to be $15,000 or $15,300 off the break. But now that, let's say you pay yourself $30,000 in that net income because you're now an S Corp, now that 15.3% is only going to apply to that smaller amount. The other 70,000 still rolls over to your personal tax return, but it's, like I said, it's not hit in addition to that. So you're already going to see tax savings by just making a certain election and running a payroll for yourself.
Do you have a recommendation or range for how much money you should be making before you try to be S Corp?
It ranges from CPA to CPA. My personal preference to keep things clean and simple is that if you are netting, that means after income and expenses, it's because you're taxed on your net income, not on your gross. If you're netting at least $50,000 consistently on an annual basis, you should be starting to make heavy considerations from an S Corp election. And the reason why is that it costs to be a S Corp. One, it's a separate tax return, so you have to pay for that. And you gotta pay for the K-1s and the state filings related to that. Two, you, like I said, you have to run a salary for yourself. Are you going to do your own payroll? Are you going to go through a QuickBooks or Gusto type of system? Or are you going to pay ADP or Paychecks to do it? Like each of them are going to cost either money or time from that standpoint there. So, I mean, I know some other tax advisors they're higher in the range. Some may go up to 70,000. I know some that are as low as 30,000. It all just depends on the individual. Yeah. And once you do that cost analysis of does the tax savings exceed the cost of doing the S Corp election? Are we talking about lower middle class of non-minorities versus lower middle class of minorities? And it's like, okay, so a lot of times those worlds kind of think the same from that standpoint, where it's like this is just this immediate need for things and need to write all the write-offs and not really understand the long-term implications for certain things. Whereas the upper class and more often than not, it's like I said, the non-minority clients are kind of in the upper class, upper middle class, whatever you want to call it from that standpoint there. So it's like, okay, how do we now get into that spectrum of it there? And the main difference I'm seeing is really the people that they're putting around them. And like I said, people are always going to have, you're going to have negative influences and all that, but it's like, okay, who are you surrounding yourself with? Like I say, is it just going to be me and you talking with no attorney talking? Because if the legal stuff isn't in order, the tax stuff doesn't mean anything at all. Because the legal stuff gotta be structured together. So it's more often what I'm seeing between the different wealth classes and sometimes even just between the different racial classes. It's just the aspect of being able to delegate, understanding like the bigger picture, like not what's immediate, what's good now. Like, yes, everybody wants to save on taxes now, but if you're just going to write off everything and you can't get a loan next year, then great. Like the taxes were great. Like you got a refund, but you're not really seeing the big picture from that standpoint there. So and also just a lot more and compiling of resources. I know people get into a lot of syndications and stuff now with real estate, but I just don't really see minorities kind of I don't see them as much. I'm not saying I don't see it at all, because I'm part of minority syndications myself, but I don't see that compiling of resources to buy a business or buy that property or whatever, so that no one's straining themselves, like they're leveraging the strength of their group, whereas non-minority groups are doing that more often.
Are you enjoying this episode? Then stop what you're doing right now. Head over to Apple Podcasts and leave us a rating and review. It really helps our show get pushed to more people who are looking for the information that we're sharing here. We have to share the wealth. If you listen to us on YouTube, make sure you like the episode that you're listening to right now and subscribe to our channel. Then share the channel with somebody else. There are people out there looking for the information you're listening to right now, so make sure you share it with someone who you know needs it. Now, back to the show.
Right. So a lot of taxpayers and clients that I have, they say, I'm just a person with 2 or 3 properties. I'm just a person with 2 or 3 properties. So that's what you would think, and that's probably what you were told. There are 2 tests to become a real estate professional, and one of them is you have to work, materially participate on your real estate 750 hours per year, which when you break it down, that's not a lot. It's probably like 14 hours per week or something like that. But if you have a 9-to-5 job, that's going to be hard to prove to the IRS that you can, do a 9-to-5 job and then 15 hours a week or so on this property over here. However, if you have a spouse that they work part-time or they don't work, like a lot of my clients say, oh, my wife, she's just a stay-at-home wife, that's her job, that's what she does. And I'm like, no, that gives you access to become a real estate professional. So she's not just a stay-at-home wife, you know what I mean? If we paint this picture out the proper way, that now makes you real estate professionals, right? By default through the spouse. So
okay, so that's the only one. No, you said it was 2. What's the second one?
The second one is the short-term rental status. So I just got into something recently, and this is very indicative of Mary, my girl, that told me you can't do this and you can't do that. So what I do with my CPA, my team of CPAs, is I do the tax plan, right, for my clients. I formulate it, and then I ship it over to the CPAs to, implement. Now we go into implementation. Well, I sent over the plan and one of my clients, and the CPA said, you can't do this. And there were those words again, you can't do this, because
those are trigger words.
Yeah. Yeah. Then the New York comes out.
Yeah.
He told my client, you can't do this. And then he kind of emailed me and said, you can't do this, because he works a full-time job and there's no way that we will ever be able to, classify him as a real estate professional. And I said, there's a short-term strategy, a short-term investor part in there where it says that you only have to work 100 hours. There's a 100-hour rule. And he was like, I don't see that. I don't know that. I never saw that in my life. Now, this was a CPA that's been in business for probably 15, 20 years. He said, I never saw this. I said, oh, yeah, it's in there, and I'll send you the publication on it. Actually, you can hop on Bigger Pockets and hear about it. And then he sent me some publications. He shot me off some publications like, see, I told you. And I'm like, okay, well, if you look in the tax code, and I gave him that snippet of the tax code, yes, it does say the 750 at the top. But if you look way down deep, there's another section that says, or 100 hours, right, on your short-term rental. So it took him some time, but he did apologize. And he said, I never saw that before. I never knew about it. And I apologized to that, I went that far sending you publications and whatnot. And I said, it's okay. So that right there again showed me how my position plays as the middleman, as the advocator, as the fighter for the taxpayer, because I'm going to go deeper, right? There's publications, which most CPAs, they look at publications. And then there's the tax code. And on top of the tax code, what would trump that would be case study, case law. So that means, that's the end all be all. When it then went to court and the case was heard out and a decision was made. So yeah. So it depends on the income that's coming in. If this is a company that's coming in, generating income out the gate, $40,000 or $50,000 net, that means after all of your expenses and everything, that's where you're sitting net. You definitely want to be in an S Corp, because then you're going to have to pay self-employment taxes on the entire amount, right? So if you elect to be an S Corp immediately, then you will only pay self-employment taxes on your reasonable income. So you made $100,000, the reasonable income was $35,000. That part is what you pay self-employment tax on, not the remaining part. A lot of people, like I said, misinformation being spread around. A lot of people that I run across say that LLCs give you tax benefits, and they do not. LLCs do
pass
not,
through.
right? They do not give you any tax benefits. That's just liability, right? Protection.
Okay.
And to answer your question about the C Corp is for people that are thinking about going public. You want unlimited shareholders. You want shareholders that are not in the country. So the C Corp allows you to do all of that, right? With an S Corp boxes you in on that, right?
Okay.
That's go with the C Corp route. So to answer your question, yes, that's exactly what tax planning is. That's what I do. So I have people like yourself that come to me, and then I look at everything and I say, okay, well, we're going to have your W-2 income, whatever income you have sitting out here, and then we'll go ahead and we'll set up this S Corp. And from this S Corp, which will be the holding company, you can have different LLCs pointing out of that S Corp. But the S Corp's purpose is like the nucleus. Think about it. It's like the nucleus. It's the bond that holds everything together. And then from there, we can put you on payroll. We can, like I said, have other LLCs. We can write off your health insurance, right? That's another thing that we probably got to do a whole nother podcast on, right? Health insurance.
Yes, because I'm trying to step away from my job shortly. The main thing holding me back was like the cost of health insurance. And I was thinking, oh, maybe I'm going to need a part-time remote job, at least something like that, so that I can still get health insurance. But if I could find something reasonable and write it off,
Oh yeah,
we need to talk.
Yeah, you can write it off. Not only can you write it off, you can have it where you can get a health savings account, which is another tax strategy where we can dump money into that health savings account, and then we could self-direct the health savings account to do what we want. When I tell you that it's endless,
oh my God, so much.
It's endless what you can do. Really, it really is endless. And when I talk to my clients, they're thinking that they're coming to me just for tax savings, right? I just want to save a bunch of money. But I'm like, oh yeah, what about your health coverage? What kind of health coverage? And I keep going further, right? Taking them further down this rabbit hole. That's amazing. That things they never heard of, things they never imagined that it was even possible for them to do.
Did you love this episode of Share the Wealth Show? Be sure to connect with Nicole by following her on LinkedIn, Instagram, or Facebook. If you picked up any of the gems that were dropped by today's guest, make sure you not only put them in your bag, but if you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.